Hi, I'm Brian Arcese, multi-counselor portfolio manager on the Foord International Fund and Foord Global Equity Fund at Foord Asset Management in Singapore. Given the uncertain economic backdrop, unfortunate, though not unexpected, increasing geopolitical tensions, and volatile credit and equity markets, we wanted to take some time to outline our current macro outlook, how we've positioned the portfolio for that outlook, including two active themes in the portfolio, and how the portfolio has fared over the recent and, more importantly, longer-term periods. As was the case in 2022, the interplay between inflation and interest rates, and I would also add along with corporate earnings, will continue to be key determinants of returns for the balance of this year and into next. Beginning on the top right-hand side of this graphic, you can see that our expectation is for core inflation, driven by a respite and shelter inflation, to return to targeted levels by the end of 2024. Shelter, which is comprised of both rents and implied rents, comprises 1/3 of U.S. core CPI and is currently running at 7.2% year on year. Excluding this component from core CPI calculations results in a core CPI running at only 1.7%, with core inflation increasing at an average annualized rate of 1.2% over the past 3 months. Now, certainly it's not sensible to exclude a component comprising 1/3 of core CPI from the calculation. However, in this case, it is relevant in our attempt to forecast where core CPI may be headed. As shelter, both rents and implied rents, are calculated on a rolling 12-month basis, it takes time for the full effect to be felt, both on the upswing and on the downswing. Seeing where these components are today and where they are headed provides some degree of comfort that this component of inflation may fall from its current 7% plus pace to near zero by the middle of next year. Some forecast models show shelter inflation turning negative. Importantly, despite the projected respite in shelter, and therefore core inflation, the volatility of food and energy prices makes a return to target for headline inflation far less certain. Nonetheless, the return to earth of core inflation may provide the Fed with the cover necessary to reduce interest rates, should that be required. Despite the market's earlier strongly held views that interest rates would begin to decline in 2023, we've long held the view that rates would remain higher for longer than investors had expected. Though we are of the view that rates are at or near peak levels, we continue to believe any bias is to the upside. As I mentioned, in addition to inflation and interest rates, corporate earnings are the real fundamental determinant of returns and value. We see corporate margins and earnings near cycle peak, with uncertainty into the near to medium term. Rising corporate and consumer credit costs are beginning to take hold with increasing delinquencies, a forward-looking indicator, seen in both the U.S. credit card data and auto loan data. Much of this year has been dominated by the debate of whether the U.S. and global economy would fall into a hard or soft landing, and having been priced at times even for no landing, as a result of the rapidly rising interest rates. As we've moved through the year, as both labor markets and the economy have remained robust, investors have increasingly gravitated towards a soft or no landing scenario. We believe this complacency to be misplaced. As shown in the table on the right hand of this slide, on average it has taken 22 months from the first Fed rate hike to the onset of an economic contraction, and this data goes back 70 years. Today we sit about 17 to 18 months past the initial Fed rate hike. Secondly, and equally interesting, is to look at GDP growth from the same table for the period before, during, and after prior rate hiking cycles. Here too we see that GDP growth historically has always been fastest during periods of rising rates, and this should be intuitive, in that rates are typically rising because economic growth is robust. Now, there is no magic to these numbers. I don't want the takeaway from this slide to be that in 4 months, when we arrive precisely at 22 months after the Fed's first rate hike, that the economy enters a contraction. But rather, the takeaway should be that simply because the economy has not yet contracted is no reason to argue that a contraction won't occur. And more importantly, the lag between the time of the Fed's first rate hike and the U.S. contraction that we're expecting currently is well within the norm. Given the most recent recession was COVID-induced, and the one prior, the GFC, it's important to look at returns through a more traditional business cycle. Not that there is a normal business cycle. But looking over the past 70 years, we typically see earnings at the index level decline 10 to 12% during a recessionary period, with obvious and significant variation across sectors and firms, and a coincidental contraction in valuations. This has resulted in index declines of roughly 30% on average. Again, this is not prescriptive, though given our cautious view, coupled with elevated valuations, results in our belief that with patience, we will soon be able to purchase equities at lower prices and lower valuations. I will chat to our expectations for other asset classes later in my presentation. Before chatting through our asset allocation, I wanted to remind investors of the fund's objectives. First, to protect capital. We guard steadfastly against the permanent loss of capital. Well, second is to generate returns meaningfully ahead of inflation through a full investment cycle. Given our macro outlook and the fund's objectives, it will likely come as no surprise that we are conservatively positioned. Our gross equity exposure has been hedged using a combination of short index futures and index put options, with a 73% gross exposure to equities, hedged to less than 50%. Now, we often receive questions on our hedging practices, and we thought it worthwhile to show the build-out of our gross to net equity exposure. So as shown here, our gross equity exposure of 73% as of the end of the third quarter is reduced by 23% from our short futures positions. It's further reduced by an additional 4% as a result of the effective exposure of our put options, and by a final 6% as a result of the fund's position in Activision, soon to be acquired for cash by Microsoft. This in total serves to reduce equities to 40% of the portfolio. And finally, should our put options move into the money, should the S&P fall below 4,000, our net equity exposure of the fund would fall further to 27%. Now, as of present day, we've exited our position in Activision, and our gross equity exposure has decreased to 64%. This is reduced by 24% again as a result of our short futures positions, and further by an additional 5% as a result of the effective exposure of our put options. This results in a current net equity exposure of 35%. Finally, again, should our put options move into the money, with the S&P falling below 4,000, our net equity exposure would fall further to 21%. The fund's second largest allocation is to cash, both cash held on deposit and in money market funds, as well as synthetic cash created as a result of implementing our short futures positions. We believe strongly that cash is an asset class that can and should be prudently used in our portfolio construction. Our ability to hold a meaningful portion of the fund in cash in 2022, a year in which both equities and credit declined materially, protected significant investor capital. Next is the fund's allocation to fixed income at 11%, a combination of high-quality, short-duration sovereign and corporate credit. As a reminder, this is a market increase from the near-zero credit held only 18 months ago. The fund's unconstrained mandate allowed the managers to be absent credit during a period of rapidly rising rates, bond prices moving inversely to rates, again protecting a significant amount of capital. Today, however, interest rates have risen to a level attractive enough to justify a growing allocation. At 6%, the fund's gold position provides a proper hedge against both volatility and geopolitical risk. Importantly, we don't view gold as a sound hedge against inflation. The non-interest-bearing metal does face headwinds as real rates rise, and cash provides an attractive alternative. But the asset's true value of a hedge can be seen clearly in its month-to-date performance following increased volatility and the unfortunate boiling over of another geopolitical flashpoint. Gold has risen 7%, while global equities have fallen 3% over this period. Finally, the fund holds a 3% position in listed property. Property is an exceedingly local investment, and our position is held in Wharf Holdings, a leading developer and operator of A-class retail and office space in Hong Kong. Hong Kong property valuations are the most attractive they've been in nearly 2 decades, with shares of the firm trading at a substantial discount to book value. The firm has no net debt and is and will be a beneficiary as tourists, in particular Chinese tourists, return to Hong Kong. As shown on this slide, the fund remains diversified across both regions and sectors and is, in fact, more diversified regionally than a traditional global fund. Additionally, though not forced by mandate, the fund does hold equity positions in nearly every economic sector, though not at traditional benchmark weights. The fund is diversified across several economic factors. Now, on the bottom portion of this slide, one can see the fund's largest exposures by sector are to the materials and healthcare spaces. And I'll take just a couple of minutes to walk through each of these. We often receive questions regarding our materials exposure, particularly in attempting to reconcile our sizable weight in what is viewed as a cyclical sector with our cautious macro view and overall conservative positioning. Now, this is a sensible question. So first, as seen here, the fund's materials exposure is diversified across industrial commodities companies, precious metals firms, agricultural commodities players, and energy firms. Additionally, many of the securities themselves are less cyclical than traditional materials companies. Within our industrial commodities bucket, for example, are positions in Air Products and IFF. So Air Products is a leading industrial gases company, which, although certainly supplying industrial cyclical manufacturing companies, also supplies gases to more defensive industries, such as hospitals. Many of the firm's customers are on take-or-pay contracts, providing predictable cash flow through economic cycles. The firm has grown its dividend consistently throughout its corporate history, and is one of the few firms to have grown its dividend through the global financial crisis. Similarly, IFF, formerly International Flavors and Fragrances, sells into the food and beverage, fragrance, and personal care markets, end markets which are not only more resilient than the economy, but also selling products into each of these end markets which are critical to the taste and smell of each product. Once an IFF formulation is in a product, whether food or fragrance, it is rarely replaced. Our investments within the energy complex are far less cyclical than the industry overall. SBM Offshore, for example, is one of only 2 large contractors globally offering design, build, and maintenance services for FPSOs, floating production storage and offloading vessels, for deepwater offshore drilling. The firm's backlog and cash flow spans literally decades into the future. The company pays an 8.5% dividend yield, which is backed by cash flow, a long-term backlog, and increases with inflation. Our materials exposure is comprised of companies whose earnings and cash flows are not only less cyclical than a traditional materials peer, but also offer more certainty. In addition to providing attractive, risk-adjusted total return, each offers a proper hedge against inflation. As highlighted earlier, while core inflation has continued to decline, investors must be vigilant against the less certain path of headline inflation, driven by more volatile food and energy prices. In a scenario where global inflation measures return to target in the near to medium term, the underlying fundamentals of each of our materials firms will drive returns, while in a scenario where headline inflation remains stubbornly high or even accelerates, these holdings provide much-needed protection to the portfolio. And this benefit was seen clearly in 2022, where investments in the materials and energy sectors contributed meaningfully to the fund's total return in an environment where global equities and bonds declined. The fund's second largest exposure, and one less surprising to investors given its defensive characteristics and our cautious positioning, is to healthcare. As seen here on the top left graph on this slide, the over 65-plus population, represented by the line in red, is the only demographic cohort with a growing population. This population is doubling over 15 years, from 2015 to 2030, and will continue again to double in the coming decades. As the propensity and the requirement to spend on one's health increases dramatically with age, these demographic shifts provide a solid tailwind to sector returns. Additionally, as seen on the graph at the bottom left-hand side of this slide, annual growth in healthcare expenditure, as shown in red here as well, is far less cyclical than overall GDP growth, shown here in brown. The demographic tailwind and relative resiliency of the sector provide an attractive backdrop for healthcare investments. Now, that being said, it's always about the underlying firms and their earnings, in particular, cash earnings that they're able to generate. Our healthcare holdings consist of companies such as United Healthcare, the undisputed leader in U.S. managed care, a firm that has consistently bent the curve on medical cost, able to offer superior care at lower prices with an increasing gap between its offering and peers. Earnings have consistently grown at mid-teens rates. In addition to services, the fund holds investments in large, diversified, well-managed pharmaceutical firms such as Roche. Roche, a global market leader in putting forward innovative therapies for cancer, hemophilia, and other rare diseases, while also growing one of the world's leading diagnostic franchises. Like our materials holdings and the balance of our investments, the fund's healthcare exposure is comprised of companies whose earnings and cash flows are backed by strong and defendable business models, managed by executive teams that have a history of being solid stewards of capital. These firms provide ballast to the portfolio during times of uncertainty, while not sacrificing long-term growth prospects. Our conservative positioning bore exceptional fruit in 2022 as our hedged equities, the absence of credit, high cash positions, materials, and inflation hedges each contributed to the fund's positive return in a year when both equities and credit experienced mid-teens declines. That conservatism, which we still feel is prudent, has not yet borne out in 2023. The fund's short futures and push positions, while beginning to bear fruit in recent days, have weighed on fund performance over the year-to-date period. Additionally, shares of fund holding FMC, a global leader in agricultural crop protection, declined on weak second quarter results. The firm is continuing to grapple with COVID-related supply chain and sales channel disruptions, which are expected to be worked through in the coming quarters. Additionally, this year, market performance, particularly in the US, has been incredibly narrow, with the so-called Magnificent Seven equally weighted, returning 83% year-to-date. And this compares to the S&P, excluding these large 7 technology companies, only increasing 4% on a year-to-date basis. Taking the 2 years together, the fund has bested global equities, bonds, and the peer group. This is no consolation to us as managers, however, as we remain acutely aware that despite the fund's solid performance versus all comparators, we've still not preserved capital to the extent that we would have liked or feel that we should have. Our short-term performance, however, is of little surprise when looking at our long-term record. The fund does tend to lag global equities during periods of robust equity performance and earn its stripes in volatile or down markets. This was demonstrated clearly with the fund posting robust performance in 2022 and disappointing returns in the current year. This is also seen clearly when looking at the fund's performance during the technology bubble of the late 2000s or the GFC in 2008. While lagging markets in the run-up of each cycle, point to point through each cycle, the fund has provided equity-like returns and has done so with half of the volatility and half of the drawdown. Despite our cautious view and the fund's conservative positioning, we remain strongly convicted in the securities we hold in the fund. We have learned over many cycles to construct portfolios which are not reliant on a single outcome, but are rather all-weather, to not only thrive when our views come to fruition, but also to survive and grow in varied market and economic environments. The fund remains an ideal holding for conservative, long-term investors.